Welcome back to GMS Podcasts. Today, we are starting a focus series on one of the most important drivers of ship recycling values, steel. In our previous discussions, we have looked at the broader fundamentals of ship recycling. But in this series, we want to go deeper into one specific question that owners often ask us. Why do recycling offers move when steel prices move? And sometimes, why does that relationship look less direct than people expect? I am joined today by Jamie Dalzell, head of our Singapore office. Jamie is close to owners, cash buyers, trading desks, and recycling destinations, so he sees both sides of the equation what owners expect and what recyclers can actually pay. Welcome, Jamie.
Thanks, Naeem. It's great to join you for this series.
Everyone in our market knows steel is central to recycling pricing. But in practice, yards are not simply looking at one steel number and turning that into a bid. When you look at a candidate vessel, how do recyclers connect plate prices, resale liquidity, and timing risk?
What you said is exactly the right way to frame it. Steel is the foundation of the recycling offer, but it is not a simple formula. A recycler is not only asking, though, what is steel worth today? He is asking, what can I recover from this vessel? What can I resell? How quickly can I sell it? What currency will I receive? And where will the market be by the time the steel is actually sold? The largest component of the vessel's value is steel, especially re-rollable steel. But the final bid also reflects local market liquidity, buyer confidence, finance, currency, cutting time, and the recycler's risk during that whole period. So yes, steel drives the bid, but the bid is also a view on execution and forward risk.
That is an important point. A ship is not bought today and converted into cash tomorrow. There is a time lag between purchase, delivery, beaching, cutting, and resale. So, in commercial terms, the recycler is really buying future steel inventory.
Exactly. A recycler may buy the vessel today in US dollars, but the recovered steel will be sold later, usually in local currency. During that period, steel prices can move, the currency can move, downstream demand can change, financing costs can also shift. That timing gap is one of the biggest risks in ship recycling. In a stable market, a yard may be prepared to work with a tighter margin. In a volatile market, the yard has to build in a larger buffer.
So, it is not enough for an owner to say steel prices are firm today, so recycling prices should immediately rise.
Correct. Steel prices are the foundation, but recyclers price forward risk. If steel is firm today, but buyers believe the market could soften before resale, offers can remain cautious. The strongest recycling market is not just a high price market, it is a high price market with real liquidity, finance, and confidence.
As we all know, steel plate is usually the headline reference in our market, but the bid is not driven by plate alone. Owners sometimes focus on plate prices, while recyclers are also looking at the wider steel chain. So, Jamie, how should owners read plate movement alongside re-rollable demand and downstream appetite?
Plate prices matter because ship steel is largely re-rollable steel. Depending on quality, thickness, and condition, that material can be processed and resold into the domestic steel market. So plate gives recyclers an indication of what recovered ship steel may fetch. When plate demand is strong, yards can usually bid more confidently. When plate buyers are slow, bids become more defensive. But plate is only one signal. Recyclers also watch rebar, billet, construction demand, mill activity, trader inventories, import pressure, and payment cycles. A quoted steel price is useful, but the real question is whether that price is executable.
That distinction matters. In our business, a quoted level and a real transaction level can be very different.
Exactly. A recycler wants to know whether mills are actually buying. Are traders restocking? Are rolling mills active? Is construction demand absorbing finished steel? Are end users paying on time? If the answer is yes, the yard gains confidence. If the answer is no, a high quoted price may not translate into a strong ship price.
This is where the recent market gives us a useful lesson. There are periods when demand remains present in the subcontinent, financing becomes more workable in certain markets, and pricing remains firm by historical standards. But tonnage still does not arrive in meaningful volume. So steel may drive the bid, but it does not automatically release ships.
That is a very important distinction. Steel drives what the recycler can pay, but the owner's decision depends on a wider commercial equation. If freight is strong, the owner may continue trading. If the vessel has employment, the owner may delay recycling. If there is uncertainty around routes, bunkers, sanctions, or delivery, owners may wait. And if the beaching window is closing because of monsoon or seasonal timing, the opportunity can become seasonal rather than immediate. That is something we see often in this market. Yards may want ships, financing may be available, pricing may still be there, but owners may not release enough tonnage within the available window.
So steel sets the base, but freight timing and owner optionality decide whether the vessel actually comes.
Exactly. A recycler can only bid on the tonnage that is available. If freight earnings are strong, especially in dry bulk, older vessels can stay employed longer. In that case, steel prices may support recycling values, but they may not be enough to pull ships out of the trading market.
Now let us go deeper into downstream demand. From experience, recyclers do not only care about the price, they care about how deep the market is at that price.
Absolutely. The recycler's confidence comes from the downstream chain. If mills are active, traders are liquid, construction is moving, and buyers are paying, yards can recycle, process, and sell with confidence. That supports stronger bids. But if inventories are high, buyers are waiting, mills are slow, or payments are stretching, the recycler has to assume more risk. That usually reduces the bid. In ship recycling, liquidity is as important as price.
So a high price with no buyers is not a real market.
Correct. A slightly lower price with active buyers, fast turnover, and reliable payment can sometimes be more valuable to a recycler than a higher price that cannot be executed.
Plate gives us the direct reference, but rebar and billet often tell us whether the wider steel chain has momentum. How much weight do you give those signals?
They matter a lot. Rebar demand reflects construction activity. Billet demand reflects mill confidence and production appetite. If construction is active, rebar consumption improves. Mills stay engaged, traders restock, scrap demand improves. That gives recyclers more confidence. But if rebar demand slows, billet softens, or construction activity weakens, the whole downstream chain becomes more cautious. So plate tells us the direct value of ship steel. Rebar and billet tell us whether the wider market can absorb the material.
So plate tells us the value, rebar and billet tell us the health of the chain.
Exactly.
Inventory is one of those signals that can quietly change the tone of the market. If mills and traders are already carrying stock, how quickly does that feed back into recycling bids?
Very quickly. If there is too much inventory sitting with mills, traders, or end users, demand for fresh recovered steel weakens. Recyclers may still be able to sell, but they may need to accept lower levels, slower payments, or longer holding periods. That directly affects how much they can pay for a vessel.
And imports can also cap the market.
Yes, if cheaper imported billets, plates, or scrap are available, domestic buyers use those levels as a reference. That can cap local steel prices and reduce the recycler's resale expectation. So even when local demand exists, import competition can limit how aggressive yards can be.
For owners, the practical takeaway is that steel is not just one number. It is a chain. Plate prices, rebar demand, billet movement, construction activity, inventories, import pressure, currency, finance, and downstream liquidity all influence the recycling bid.
Yes, and owners should also remember that recycling offers are not arbitrary. They reflect what the recycler thinks can be recovered, sold, financed, and protected against market movement. A strong offer needs three things: steel value, liquidity, and execution confidence. If one of those is missing, the bid changes.
That is a strong place to close episode 1. The key message is simple. Ship recycling prices are built on steel, but the steel market has several layers. The headline plate price matters, but so do demand, liquidity, inventories, imports, currency, finance, and expected price direction. Most importantly, steel drives the bid, but it does not automatically release the ship. Freight, timing, and owner strategy also matter. In the next episode, we will look at why the same steel driven logic produces different recycling prices in Bangladesh, Pakistan, India, and Turkey. Jamie, thank you for joining us. See you next week.
Thank you, Naeem.